All right, good afternoon, everybody. It's 1:30 on September 17th, and we're joined on, as we always are on Mondays at about 1:30 with Adam Collins from Movement Capital. Adam joins us and discusses the latest COT report, market seasonality, and a lot of other interesting information on the markets. Adam, thanks for joining us.
Yeah, happy to be here. So right out of the gate, nothing I talk about is investment advice, so don't treat it as such. But one thing I wanted to run through early on is for any new listeners, the most common question I get is, let me take a step back. I mainly cover COT data. COT data is, it covers how people are positioned in futures markets. And there's lots of different ways to look at the data. So for example, this is what a raw COT report looks like. And it just is like a point in time snapshot of how these different types of trader categories are positioned in the futures markets. And so this website and what I try to do is try to give context to current positioning. So if somebody tells me, Adam, speculators are long 50,000 contracts, short 25,000 contracts, and their net position is, net long 25,000. What does that mean to you? It doesn't mean anything to me because I need to know if that number is extreme or not relative to the past. And so basically the main metric I'll look at is called a 5-year percentile. And all it does is just sort of like normalize the net positioning relative to the past couple of years. But I think it's important to show people how I actually reach that number. And so here's a walkthrough of it. So in this example, this is for the wheat market, and this is looking at producers and merchants, or quote unquote commercials. So these are the two sort of main columns. We've got the longs and then the shorts. And then to get the net position, you literally just, net the two together. And then what I like to do is to take that net position as a percentage of open interest. And open interest is just the number of outstanding longs plus shorts between, two different parties. And you might ask, why do you do this step and not just sort of stop here? It's because these futures markets can sort of expand or contract in size. So you can have something like, WTI futures, which have grown much more popular over the years. And so if you just look at a net number, it's sort of either deceivingly large if a market's grown really quickly, or it's deceivingly small if a market has contracted. And that actually has happened in a couple of markets, such as Palladium and NASDAQ futures. And so it's really important to adjust a net position by the size of the market. Otherwise, it sort of looks weird. And so this is sort of the net position of commercials in the wheat market right now. And you can see they're leaning net short. They got a net short position. It's about net short 20% of the open interest. But remember, I don't care about the current. I care about if the current is extreme or not relative to the past. And the past for me equals 5 years. There's nothing special about 5 years. You can do 3, 4, 5, 6, 7, doesn't matter. So what you do is let's look for this number, this sort of net number as a percent of the open interest. How high has it been over the past 5 years? What's sort of the max number? And you can see the formula right here. It's very simple. It's just a max over the past, 5 years of weekly data. And we can see that over the past 5 years, sort of the most net long commercials have been in wheat futures has been net long 7% of the open interest. And then their minimum position, most net short they've been, has been net short 26% of the open interest. So we can sort of, and then to create a percentile, here's the formula. It's just current minus min divided by max minus min. And it just creates a number that's scaled from 0 to 100. So for example, like right now, I'll sort of override it. Right now, if I sort of hard coded in the current net position as 7%, you'll see that the 5-year percentile jumps to 100 because it's sort of like the current position is as high as it's been over the past 5 years. And so, in a nutshell, that's the calculation of a 5-year percentile. We can see right now for wheat, commercials are leaning pretty net short, not extremely so. So I think it's important to know what's extreme and what's not. So for me, I define as any percentile greater than 90% or less than 10% as sort of extreme positioning that I deem, worth paying attention to. And more often than not, positioning is not extreme, and it can honestly be disregarded. But whenever it does get really extreme, it matters. And we can see how a couple weeks ago in wheat. Commercials got super net short, and it ended up being, this is anecdotal, but it ended up being a fairly good time to short wheat because it fell back a little bit. But anyways, purpose of this document is showing you calculation of a 5-year percentile. It's very basic. But let's go back to the data of what's new this week. So let's see. So the way this website is oriented is I've got all these individual pages that show these 5-year percentiles for each contract. And in fact, we can go look at wheat and see the producer and user position of right at 20% down here. And so that's sort of what we just calculated, that green line right here. But so this is sort of the commodities page. It's got all the individual contracts, but the main page I look at is the dashboard page. And it just aggregates together all of the 5-year percentiles for a given trader category, for a given asset class. So for example, this covers commodities and this covers speculators in commodities. So we can see what people are really long and what people are really short. And probably the biggest change this week is that there just aren't any crowded spec long trades in commodities anymore. Wheat, sort of coincidentally, because I've talked about it, wheat was a crowded spec long a couple weeks ago, but no more. They probably pulled some longs and added to some shorts. But while that has changed, what has not changed is that there still are a bunch of crowded commodity spec shorts, and it's the usual suspects. We've got precious metals, soft commodities, and so that's sort of not new. And these positions truly are extreme. So let's sort of dial into one of them. Let's look at silver. So we got silver right here. So yeah, speculators have a 5-year percentile of 2%. So it means they are almost as net short as they've ever been over the past 5 years. So it's very extreme positioning. But one thing that I think is very important, every sort of new trader, when they get exposed to COT data, it's I see this time and time again, they always want to fade extreme spec positioning. So if you read, everybody's short silver, everybody's long WTI, they sort of instinctually say, I want to fade that. I want to go on the other side of that trade. And that's to their detriment because it honestly doesn't work that often because extreme positioning isn't that rare. But what is rare is when you have a setup of when everybody's on one side of the boat and price action goes against how they're positioned. Because let's think about it. Like right now, if you're short silver, if you're a trader that's short silver, are you under pressure? No. The trade has gone your way. It's traded beautifully. You don't have a huge catalyst or incentive to pull that short exposure. But let's say tomorrow morning, silver gaps up 8%. Are you under pain? Yes. And so there's a big reason for you to maybe pull some short exposure. And so for me, with COT, I personally like to see crowded positioning paired with technicals that put that trading entity, under pressure. And that's honestly not the case in precious metals right now. They've been, in a consistent downtrend. But let's look at some other positioning stuff. So this is solely commodities up here. This is financial futures. Similar to commodities in the sense that there really aren't any crowded longs, but there are a couple of crowded shorts. And this has sort of changed because a month ago, I was talking about how, the Swiss franc was a very crowded short trade against the USD. Not so much anymore. They've definitely cut back on their short exposure, and it's not, mutually exclusive from the fact that the Swiss franc has recently rallied against the USD, so it's sort of put them under pain. But the New Zealand dollar is still a very crowded short trade against the dollar. In fact, it's the most crowded short FX trade I track. And here's sort of a zoom in view of the positioning. And we can see how, in late 2015 that did not work well, but that's obviously just a sample size of one. But yeah, if you're trying to if you're trying to sort of look for a trade that will have sort of some additional juice if the USD rolls over, I think you could potentially find it in the Kiwi dollar just because of how concentrated short positioning is. And then right here, this is looking at totally different trader category. This is looking at hedgers. So the actual, companies that produce or use a commodity. And what's interesting here is I honestly can't remember a time of when net commercial positioning was so bullish is the wrong word, but was so minimally net short or just a little bit net long, because this is sort of a tangent, but commercials on average, they're almost always net short. It's because when you've got these two categories, you got producers, you got users. Producers, that's like a corn farmer. And when they quote unquote hedge, what they're doing is they're selling corn futures to lock in prices for their future production. So hedging to them equals selling. With users, that's something like, I don't know, imagine a company that needs to buy, platinum for a catalytic converter in a car. So when users hedge, they buy futures. And so the reason why sort of producers tend to dominate is because they're typically more sensitive to price. And so if you're a commodity user, sometimes you can sort of pass, price increases onto the end user. But if you're a corn farmer, you probably know you're not going to be profitable, under a certain price. And so you've got this bigger incentive to sort of hedge and lock in your margins. And so all that to say, at the moment, commercials are not, actively shorting and hedging future production. And it's in a lot of contracts. It's in silver, coffee, platinum, sugar, soybean oil, WTI, lean hogs. And so that's a lot of contracts. And so the plain English takeaway is that across totally dissimilar commodity markets, you've got commodity producers saying, hey, we really don't want to hedge a lot of future production at these price levels. And so that's sort of a snapshot of COT, and we can blast through some equity stuff real quick. So when it comes to equity futures, I really only pay attention to the S&P contract just because it's the amount of volume is so much bigger than like the Dow and NASDAQ. And we can see that, specs with the white line got super net long this, April, and then it's come back. And so they've taken off some long exposure, and I think probably added a little short exposure, maybe not a lot. But what's interesting about this is that sort of positioning happened during a very strong rally. That's not what you typically see. You typically see positioning and price action being synonymous. And so, yeah, it's interesting to me that specs have grown less net long, ES futures as they've risen. And then VIX is interesting in that I tweeted about it earlier, but so a lot of people, there's sort of this narrative that in January and early February, the traders were carrying this like massively net short VIX position. And that wasn't the case. Traders were net short, and you can see it like right here. Okay, so it was like middle of the road positioning for speculators with the 5-year percentile of 49%. But when you look at sort of the dollar amount of spec positioning, they were net short around 350 million. And what's interesting is now they're actually net short a lot more than that. They're net short $1 billion. And so the takeaway from what I just said is that speculators are more net short VIX futures now than they were in late January before, that trade sort of blew up. And so that's probably worth keeping an eye on. Let's turn to seasonality. And so seasonality is just the, typical tendency of commodity contracts to either rise or fall in certain months of the year. And so this is sort of an aggregation of average monthly performance across all these different contracts. So here's a look at October. So what's historically done well is on the left, and then what's historically done poorly is on the right. And so the average best performers in October have been, we've got some of the agriculturals. We've got OJ, oats, soybeans, corn. OJ is probably sort of a hurricane risk thing. And on the right-hand side, we got the stuff that's historically been weak. It's honestly energy. It's, crude, heating oil, RBOB, and then nat gas, and also cocoa. And so that's sort of a seasonal view of October. And if you want to look at September, about halfway through the month, but it's sort of an opposite case. We've had historically September's been favorable for risk-off assets like gold in the 30-year. Also oats stand out. And then on the right-hand side, September's historically been pretty bad for some of the agriculturals like, soybean oil, meal, platinum, soybeans. And then here's another interesting chart that I think, so like a lot of people focus on this chart, and that's fine. This chart, it's really interesting to me, and let me explain why. So this is showing the current degree of either contango or backwardation in commodity, like the term structure. And so this is relevant because the term structure has a big bearing on sort of long-term commodity returns. I know it's not super relevant if you're just an intraday trader, but if you're holding something for days, weeks, or months, this actually is very relevant. So think of it as the cost of you holding that position. Here's why it's interesting. When we started this year, a lot of commodities were in backwardation, which meant that sort of like the front month was more expensive than a deferred contract. And the reason why that matters is because if you're pursuing long exposure in the front month in a backwardated curve, you sort of have this positive expected value roll yield that you capture over time, which is sort of it is a tailwind for returns for that trade. And that's not the case now, is what I'm getting at. Backwardation has pretty much all but disappeared in all these commodity contracts. And in fact, a number of contracts have pretty steep contango. What that means is that, especially for, these people who have sort of been spooked by inflation and they put on, long commodity exposure through like, ETFs or mutual funds, that position has less of an expected upward drift over time when these curves sort of shift into contango that sort of represent a cost you incur to roll the position each month. And so, the biggest offenders for, steep contango right now are natural gas, corn, coffee, and wheat. So it's costly to maintain long exposure in those contracts. Then here's momentum. This is looking at 12-month roll adjusted momentum. And so what this means is we're looking back over the past year, and I think it's important to adjust it for the roll, because you need to make sort of the momentum realistic. And so what's done the best over the past year, what commodity contracts have been WTI, heating oil, S&P, wheat. What's done the worst are soft commodities, precious metals like silver, sugar, coffee. And then we can dive into a couple individual seasonality contracts. So here's like the 30-year bond. It's sort of interesting because, the 30-year bond, a lot of these risk-off assets, they typically rip in late summer as, risky assets typically get more volatile. It really didn't happen this year. It happened a little bit to some degree in, August, but it sort of fell apart in September of where, the 30-year just sort of, didn't catch a bid. And so, and then this graph below is showing like average performance by month. It's the same data, just a different view. And so that's the 30-year. Euro seasonality. Honestly, currencies don't exhibit a ton of seasonality, but the one thing that actually is pretty stable is euro, and honestly, any foreign currency typically falls in January, rips in December. Same with the yen, I think, a little bit less so, but it's sort of a USD thing. Of the USD typically goes up in January. Then we got S&P seasonality down here. We're right in line with the blue line is like average 10-year seasonality. And so we're right in line with that. Obviously, we've been in a big bull market, and so these short-term 5 and 10-year averages are quite positively sloped. Then let's look at some precious metals because they're topical. So we got palladium, sort of interesting because it's the only precious metal that's actually held a bid over the past couple weeks. And if we're looking at palladium seasonality, typically rips into Q4, strong October, November, December. Then we got what else? We got silver. Honestly, not any big seasonal trend the rest of the year. You might look at this orange line and say, whoa, that's sort of fallen. That's only over the past 5 years. I assigned the most weight to the white line, the 20-year contract. And with precious metals, like I said, there's not much more, typical yearly seasonality, but do sort of, be aware of all these precious metals. They typically rip in January and February. And so keep an eye on that. And then we can look at another seasonality plot. We can look at let's look at energies. So energies, we can look at WTI monthly seasonality, quite weak in October, November. In fact, those have been the 2 weakest, back-to-back months in WTI over the past 20 years. So that is notable. And then also WTI, this backwardation fell out, and so that's not a good thing.
That's a pretty interesting chart there. WTI, the way it shows Q4 typically negative, Q1 typically positive.
Yeah. And it's not just WTI; it's also heating oils. It's the exact same thing. And then
even more so in heating oil, it looks like.
Yeah. And so last website I'll cover is, so just as the CO2 website, as positioning, seasonality is seasonality mostly. This other one, it's mainly concerned about the S&P, and it looks at all these different indicators. And I wanted to put everything under one roof. I wanted to have a quick view of technical, sentiment, rates, macro. So technical overview, nothing you don't know. Technicals are strong for the S&P right now. Seasonality is actually historically quite weak until November 1st. The November 1 to April 30 period has been very robust over the past couple decades in the U.S. stock market. That's what the blue line shows. Blue line equals only be long, November 1 to April 30. Orange line is only be long the other 6 months. So you can see there's a huge sort of magnitude in performance. FOMC drift is this weird quirk of where the S&P typically rises in the 20 trading days leading up to the FOMC announcement. And the orange line is being long in the other days. And it's crazy. Of basically only being long to 20 days pre-FOMC has matched buy and hold while being in the market only like 80% of the time. So that's nuts. This has changed actually this week. So this is worth pointing out. So the buyback blackout is sort of the tendency of companies to suspend share repurchases in the 5 weeks leading up to quarterly earnings announcements. Now, not every company sticks to it, and obviously that sort of time window is different for each company. But these earnings announcements, they sort of cluster, and so I sort of selected a time window that includes the majority of them. And this week we actually started to enter the very first amount of that blackout period for the next batch quarterly earnings. And so in a year of where buybacks are so huge, maybe this is, worth paying attention to a little bit more, especially as we get further on in time and sort of the more companies fall into that blackout window. And this metric should,
I was just going to say, if you could take us through each line there, white, gold, blue.
Yeah, so for example, right here, and I sort of define the time periods. And so we just fell into the Sep 15 to October 25 period. That's sort of the blackout for Q3 earnings. What the blue line is when you're in that blackout period, or rather the blue line is being long outside of the blackout period. The orange line is only being long within the blackout period. And so it's both lines together cover 100% of time. And you might ask, well, wait a second, if you sort of sum these two numbers together, why doesn't it add up to the white line, which is buy and hold? It's just because the graph is linear and not logarithmic. And so if it was log, it'd be equidistant. So anyways, in plain English, we're just starting to enter the blackout period. And then here's margin debt. I like to look at the year-over-year change in margin debt because, a lot of people look at it and they quote out these numbers like, there's $600 billion worth of margin debt. And that's very true. But I think the rate of change matters more than like an absolute level. And so margin debt has actually been quite tame. It's only risen by like 10% over the past year relative to the S&P, which is like up 20% over the past year. Now, what sort of gets scary is two things with margin debt. One is when it starts to contract year over year. That means when the level of margin debt is sort of falling year over year. And then the blue line is only being long S&P when margin debt growth is positive year over year. White line's buy and hold. But the other sort of scary scenario for margin debt, in my opinion, is when it really starts to accelerate. So, for example, 2000, 07, both those times were sort of defined by margin debt rapidly accelerating. So what that means, what people were actually doing with their money, is they were quickly levering up. And in fact, a lot quicker than the underlying asset, the stock market was rising. And so that, to me, is a very vulnerable situation. And it's not the case right now. So I don't peg that as a current worry with margin debt. Here's sentiment. And so this is just looking at different sentiment indicators for the S&P. This is the AAI. It's the American Association of Individual Investors. So it's mainly a retail survey. What this line is, it's just showing the difference between the people who respond percent bullish and the people who respond percent bearish. And so when it's red up here, that means tons of bulls. When it's down here, tons of bears. And obviously you want to, the intuition behind it is be careful when everybody's bullish. It's not the case right now. It's just the sentiment in the surveys in the middle of its historical range, so it's nothing to write home about. We got some other stuff. We've got NAME, which is more of an institutional, like financial advisor type survey. Those people, money managers are definitely leaning more bullish, but sentiment, in my opinion, is one of the least useful types of indicators in isolation. So let's say you gave me an environment where technicals were strong, macro was strong, but sentiment was frothy. People were bullish. That doesn't mean that much to me. I care more about, honestly, technicals and macro. But anyways, here's another sentiment survey. This is a put call ratio. In fact, this is the total put call ratio. And we can see that, when it's up here, this would mean that people would be buying a lot of puts relative to calls. People are freaking out. If it's down here, that means not a lot of interest in puts relative to calls. So people are complacent. And you can see that this is sort of like the others where it's like in the middle of its range. And so nothing really to write home about on that. We got some big stuff. This is looking at the degree of contango or backwardation, the VIX curve. And contango is quite steep, but that's just because front month VIX futures are expiring this week, I think. Okay, we got some rate stuff. We got yield curve. This is a fun graph, in my opinion, because with the yield curve, everybody freaks out about inversion. They say, "Oh my God, when's the curve going to fully flatten out and invert?" Right? That's when you pull S&P long exposure. Not the case, because the lead lag time has been all over the map. Sometimes the curve's inverted 6 months prior to S&P top. Sometimes it's taken 2-3 years. So to me, it means nothing. But what has historically worked is sort of opposite. Isn't when the curve inverts. It's when the curve rapidly steepens, as in front rates falling relative to back rates. And so here's what this graph shows. Down here, we got this like this green line. That's the 10-year Treasury yield. This like orangish line, that's the 2-year yield. And this middle plot is just showing you the 12-month change and the difference between the two. And so, for example, if this line is in the red right here, this means that the curve has recently steepened a lot. And historically, a curve has steepened a lot because front month rates have massively come down in a recession. And then when the line is down here, this means the curve has flattened a lot over the past 12 months. And obviously, the Treasury curve has flattened a lot. And so, who knows? We're in such a weird rate environment if this indicator will work in the future. But over the past 2 cycles, a really quick steepening has sort of been worse for the S&P than a quick flattening. We got high yield spreads. So this is just looking at interest rate spreads of high yield bonds relative to treasuries. And basically, if this line is above sort of the smooth moving average, that says to me, spreads are blowing out. People are freaking out. Not the case right now. This is the TED spread. It's sort of a measure of stress in the banking system. And if you remember, earlier this year, it was a big headline. Everybody's freaking out over the LIBOR OIS spread,
Right.
and which is related to the TED spread. All it is TED spread is LIBOR, which is 3-month unsecured minus 3 months Treasury, and so basically it's fallen back. I think we're almost at year-to-date lows for the TED spread, and so 3-month LIBOR is just a hair above Treasuries now. And so finally, we got macro indicators. Industrial production, in summary, macro indicators are very healthy for the U.S. We've got industrial production is rising year over year. So that's a business activity indicator. We've got retail sales, which is more consumer driven. And I honestly think more relevant for the U.S. economy because our GDP is so consumer spending centric. So retail sales, people spending money has risen, 3.7% over the past year. Typically when that's contracted, that's been really bad for the S&P. We got unemployment rate. And so to me, think about this. If that unemployment rate is steadily rising, that means people are losing their jobs. People are spending less money. It's typically bad for the economy. That is not the case right now. The unemployment rate is low and grinding lower. If it started to rise above a moving average, that would be a warning sign to me. I got PMI, another business thing, and it's nuts that this recent PMI of 61 or whatever. That's a cycle high, and what are we 9-8 years into a cycle, and we're hitting a cycle high in a business activity index. That's sort of crazy. We got housing prices and EPS obviously are up over the past year. And then I've got another page on this website. It's called Composite. It's sort of like the other stuff where it's like a dashboard of sorts. And basically all those indicators, they get a flag, green light, red light, 1 or 0. Are they healthy, not healthy? And this graph sort of summarizes them all. And so on average, all those indicators are quite healthy. We got technicals are strong. Sentiments, leaning bullish, not extremely so. Rates are healthy, macro's healthy. Now I wanted to run through some other stuff really quick at the end. So this guy, his name's Kevin Muir. He runs a website called The Macro Tourist. Deeply appreciative to him because he wrote a blog post about something that I think it flew over a lot of people's heads. People were talking about, we got record short position in the 10-year. It wasn't the case. And long story short, he wrote an article that puts into English what I was conveying, the fact that if you actually slice and dice the data correctly, the current positioning in the 10-year, you can't categorize it as this blanket spec short. It's sort of a tale of two traders. Of you've got, leverage funds, absolutely. They are very short the 10-year. But on the flip side of it, asset managers, slower money like mutual funds, they're extremely long the 10-year. And in summary, it sort of washes out to quite mundane spec positioning in the 10-year. But I will say this: a very smart trader on Twitter was talking about this, and he's like, you know what? Let's take two traders. Let's say you take, a mutual fund who's not levered and they're buying 10-year futures, and let's say a highly levered, hedge fund that's, short 10-year futures. The more leverage you have, the more sensitive you are to short-term price movements. And so absolutely, if the 10-year were to rip and yields were to fall, these people would get squeezed. And so that's a good sort of caveat. And then some last stuff, some interesting charts I ran across. And this is actually quite similar to treasuries. People talk about, nobody likes bonds. I can assure you people like bonds. This is looking at, cumulative flows into bonds and equities since '09, and lots of money has flowed into bonds. This sort of deconstructed, sort of small, but this deconstructed the recent CPI print into what was rising or falling and sort of the magnitude of each sector. And so what sort of contributed to the year-over-year rise was transportation, not so much housing. This is really interesting to me. So tip yields, so these are real after inflation yields you can lock in with treasuries. They're quite high. They're at 10-year highs. And so what this means is that if you want to go out and you want to lock in, earning roughly 90 basis points over realized inflation over the next 5 years, you can do that right now. And so I think this will have sort of implications with other asset classes. For the longest time, you were just never paid for not taking risk, and now you are. Then we got sort of related to treasury stuff. This is looking at treasury interest expense. And obviously, as our debt grows and interest rates rise, the federal government will pay more and more interest expense. And then here, we've got the beta of long-short hedge funds relative to just like the past couple of years. And so we can see that it's beta to the S&P that, long-short funds, which are on average quite market neutral, they're not right now. They're leaning more long. You've got a higher beta to the S&P. So that is pretty much it. I know it was a lot, but if you got any questions on the sites or that, 5-year percentile walkthrough, I'm happy to answer them.
That was really good information. Thanks, Adam. It just goes to show you got tons of knowledge out there between your three sites. You got the COT data, you got simple stock models, and market seasonality. Yep. Tons of information. So here's a question. There are a few questions here, but one is, so looking at all the data, is there one signal that sticks out at you right now as, something that's really interesting, it matches, a few different things are lining up, and especially, COT is also confirming it, or seasonality is confirming it, that, it's looking for a trade right here?
To be honest, I don't know. The one thing though that I think is central, that's sort of like, you're right. So I can say all this stuff, all these sort of factoids about current positioning. It's all one thing. It's all a dollar trade. So specs that are super short all these precious metals, specs that are super short all these foreign currencies relative to USD. It's all, everybody has piled in a long USD, long US assets. And so I have no clue how that resolves. What I do know is that if you step up to the market right now and you place your money and you sort of say, I think, US is going to continue to be the cleanest, the cleanest shirt or dirty shirt or whatever that saying goes, you're very consensus. You're not bringing anything new to the table. And so now I'll say this, remember how we started this year and sort of the dominant narrative was like, we're going to have synchronized global growth, and it's sort of the whole global economy is firing on all cylinders. That was the dominant narrative in January, right? It was very contrarian to say that the U.S. and international would diverge and U.S. would come out on top, right? And back then, positioning was totally not prepared for that, and so that was a value add thesis back then. It is not value add now. Everybody's in that trade, and so all I'll say to that is, if you're going short USD or long term these commodities, it's definitely a contrarian position. I would be a little hesitant until, I don't know, price action would agree with you more. But USD has been sort of soft recently. So
Well,
who
that's what I
knows?
was
But
going to say. It's
basically,
pretty
yeah,
interesting. The euro got below 114, traded down to I think 113.50, and here we are almost at 117. So the dollar's actually had a, against the G10 has actually had a pretty decent pullback from, I think it was June or beginning of July.
yeah.
And then that was what I was actually going to ask you to break down. If you take a look, because I know at one point about 2 months ago or a month and a half ago, the dollar was very, very heavily long. Has that trimmed down at all?
A little bit, yeah. It's like, for example, this graph right here. So what this is looking at, so you got currencies like Aussie dollar, British pound, Swiss franc, New Zealand dollar. A couple months ago, these numbers were a lot lower. These are 5-year percentiles. They were a lot closer to sort of like,
Yeah, I remember that.
5-year extremes and net short positioning. And it sort of bucked up in that some of the shorts have covered and some specs have gone more long. Not so much in the Kiwi dollar. That's still a really crowded short. But I will say this, Euro is sort of unique in that I know when people talk dollar index, it's synonymous with Euro because it's like a 50% weight. But Euro is unique in that there's still this big residual net long position in Euro futures. I'll zoom in on it over here. Let's see. Okay. So for example, this white line, speculators. If it's up here, that means on average they're quite net long. So we're not, by no means are speculators extremely net long to Euro right now. But I'm just saying, so look at this graph, what it looks like with that white line relative to the yen, relative to Kiwi dollar, relative to Swiss franc. You can see that basically, I think the USDX might be, and people have talked about this, it's obviously a very skewed look at dollar performance, but yeah, so spec positioning in Euro is sort of unique in that that's the one foreign currency where spec exposure is still quite net long, but all the other stuff, that's where short exposure is pretty dominant.
Yeah, pretty interesting. Somebody was asking a question earlier about the New Zealand dollar, basically asking how has New Zealand changed over the past month? Can you break down the New Zealand dollar more?
Yeah,
Because price action, it seems like the chart has bounced a little bit, but still, remaining near the lower end of the range here.
yeah. So positioning really hasn't changed. Like, look at it. So it's been a very crowded short since early July, and this is a great case study into not following extreme spec positioning at face value. So if you were right here, you would have been burned by fading that, and you should not have faded that because the trend was very steady. And honestly, I haven't looked at it this morning, but the Kiwi dollar is still in a steady downtrend, and so I wouldn't for a second, be quick to go long it. But what I am saying is that if you have sort of broader USD weakness, I would expect to see, I don't know, more short covering just because positioning is so much more concentrated in that currency.
It's interesting actually. You won't be able to see this, but I'm going to bring up, take your screen down, and I'm putting up mine, and I have the New Zealand dollar next to silver, and they actually look pretty similar over the last few, basically for this year, as a matter of fact.
Yeah.
And, both in a heavy downtrend.
Yeah.
But and they're both, I think, on the sentiment meters pretty similar as well. Pretty oversold.
Yeah,
But like
for
you
sure.
said, that's the example of you can't necessarily just take this data and fade it. There's certain times where the trend's just going to continue and continue.
Yeah. No, I mean, absolutely. Yeah. Any other questions?
There was one also coming in about the VIX, because I've
Yeah.
seen a lot of mixed reports this week on the VIX and where we are versus February or January, February time. What are your thoughts there?
Yeah. In fact, I'm going to stop sharing my screen for a second, and I'll pull up this graph that I've got. I got to like navigate to it on my computer about the VIX. You can still hear me, right?
Yeah, hear you fine.
Okay. Let's see. Let me pull this up. Yeah, so this is actually, I didn't talk about that much, but I find it really interesting about how it's sort of this common knowledge narrative of everybody was short VIX in late January, and it really wasn't the case. Let me load up some of these graphs. We got hang on.
Yeah, I brought up a chart of the VIX and also next to silver, coincidentally. But yeah, the VIX had that big spike in January. And, I've seen some mixed reporting this week about what really the VIX positioning was back then and what it really is now. Because
All right, let me share my screen again. All right, you see it?
Yes.
Okay, so what this is this is looking at not, a percentile or a net position. This is looking at dollars. This is looking at taking sort of the net spec position, then multiplying it by the contract multiplier, and then multiplying it by front month VIX. And so basically, you just get a view of the amount of dollars specs for net long or net short. So in early 2018, the net position was right around here, like net short 350, 400 million going into the Feb, VIX apocalypse or whatever. And then we hit a net long position of 1.5 billion, which was a supreme fade as it has been historically. But what I'm getting at is, so here's the difference is we started here and now we're here. And so there is more net short VIX exposure than there was before VIX spiked. And here's what's interesting about it too. So I actually went and looked so remember, in that when that event happened, there was a ton of money in these short vol ETFs, and the biggest one was XIV.
Right.
And I sort of went and double checked. I was like, well, hang on, because XIV was it was accelerated, it doesn't exist anymore. But there's still some ETFs that exist, like SPXY. And I checked, I was like, well, hang on, did retail just like, shove more money into these ETFs? And I looked at the fund flows, and it's not the case. So like the retail crowd has been quite scared of that trade since, and they haven't sort of chased the short volatility ETFs. And so this positioning is not coming from ETFs, it's coming from straight VIX futures, which sort of, in my mind, whether this is well founded or not, I sort of think that the current VIX positioning is sort of less retail centric than it was at the start of the year. But yeah, what's also interesting is that the most bearish specs have ever been on the VIX wasn't, like this year at all. It was early 2016. It was sort of after the Chinese mini deval, and sort of after the S&P fell like 15%. That was when we got to really extreme VIX short positioning. And to be honest with you, they were right. That was the right position to have at that point in time. But either way, if you're somebody who thinks that sort of short VIX positioning can be an accelerant to future VIX spikes, when you look at this graph, it probably should spook you a little bit that there's more money betting on the short side now than there was in late January.
Yeah, that's pretty interesting because I have seen that that's similar to what I've heard recently, and that's pretty interesting because the talk then was how it was record shorts, and the VIX is an interesting contract because a lot of people use it for different reasons. It could be somebody who is long the market and doing something in the VIX to hedge a position or vice versa. I remember hearing for a long time there was somebody called 50 Cent who was just buying 50 cent VIX calls. And that could be somebody who's actually heavily long the
Like
market.
it's a complete. So like that stuff that gets views on websites, it means nothing. That person's hedging some monster position.
Yeah, exactly.
But like, so here's I want to talk about this too. So hang on, I pulled up the wrong chart. You raised a good point. You talked about net VIX positioning, and this is where people screwed up. So the VIX market has exploded in size over the past couple of years, and so what most people do when they look at VIX positioning is they look at the net number of contracts, right? So it's sort of like
Right.
specs are net long, 100,000, whatever. Okay, so think about this. Right now, I don't know what the number is, but let's say specs are net short, like 200,000 contracts. This is the open interest in VIX futures. Right now, there's OI of like 500,000 contracts. If you just look at net positioning, that net short number of whatever it is now is going to look like a monster relative to the size of the VIX market, 7 years ago. And so it creates this like false perception of like current positioning is more extreme than it actually is. And so it's really important in the VIX to adjust positioning for open interest.
Well, you talk about that a lot in a lot of different markets, how it depends on where it is in the cycle of the contract because, VIX is a newer contract and, a lot of different ways to get exposure to it. So that's a big point as well.
Yeah.
So, all right, Adam, thanks a lot. Amazing information as always, a lot of insight, great knowledge. Thanks for joining us. We'll talk to you soon.
Yeah, appreciate it. Thanks so much.
All right. That was Adam Collins of COT Report. He also has 3 websites: COT Report, Market Seasonality, and Simple Stock Models. Great information. We'll be back soon.